So, all right, guys, let's just start. Today we are going to be discussing about FOMC, and this is one of the news that actually move a lot. Even some traders only trade FOMC, all right? So they only trade FOMC, and it's because it moves a lot. And the secret behind it is very, very obvious. So if you watch this video, you are going to see the secret behind FOMC and you'll be able to trade it every time. So you don't need to run away from it. Because there are some news that has one behavior, while some have two behavior. All right. So the one that has two behavior, that's 50-50. But the one that has one behavior, the percentage, the probability is very, very high. You can still make your profit if you actually set the rules that I'm going to give you now. If you actually put them down and you follow it, you're going to make money on FOMC. Tomorrow is also FOMC, which I'm going to trade it. So, but let's talk about it today. All right. So it is very simple. It is something that is common, but a lot of people don't pay attention to it. All right. Whenever you see the price, whenever it's on FOMC day, that particular day, do not trade anything. All right, you can scalp, but don't hold anything till FOMC. It is a wrong idea. So do not hold the trade. All right, make it like this. Do not hold trade before FOMC. All right, that's the first thing. Because if you are holding trade, they are going to take you out wherever you put your stop loss, except if your stop loss is like 200 pips, or even if it is 200 pips and you're in the wrong direction, they will take it out. All right. So do not hold trade. Even on the morning of that day, don't hold any trade. All right. Until that particular time, and be ready. All right. Just be ready. All right. So number 2 is you find liquidity area. You find liquidity areas. All right. So major thing, all right, let me just be specific here. Major thing is to look for hold high, so or hold low. So this is the major thing, all right? So it can be a daily high, it can be monthly high, it can be 4-hour high. But most of the time, daily high is okay. So even if you can locate all of them, if you watch your daily high and some other highs, all right, you are okay, and low, you are okay, all right? That is the second thing that you need to mark. That you're going to be doing this like an hour before or 30 minutes before the FOMC news release. So you're going to be doing this. So when you do this, you'll be able to know what you want to do, all right, at that particular time. Then number 3 is to be patient. All right. You have to be calm. So you don't have to rush. It's better you miss the trade than going in the wrong direction. All right. It's better you miss it. So you have to be calm. You have to be patient and watch what you want to do. Then number 4 is the real setup. All right. The real setup is you're going to wait for them to take out and hold high or and hold low. Then you enter. They always do that. The reason why they always do that is because they would like to gather more liquidity. Then another thing is FOMC has one behavior, which is it will first of all go to the wrong direction, which is the liquidity that is going to take out. Then it will now move to the right direction. So you have to be calm because you have to allow it to move to the wrong direction first. Then you make your entry either by using buy stop, by entering or whatever it is. Then it will now move in the right direction. I'm going to show you a couple of examples, that happened this year, and you are going to see it. So let's just draw the diagram first so that you know what you're looking for. Let's say 30 minutes before the FOMC, you've marked your lows and your highs. All right, you mark your lows and your highs. Then after marking it, during the news release, then the price was consolidating like this. So during the news release, the price spiked up, taking out this liquidity. So you're not going to be trading before that. So when the price spiked up, taking out this liquidity, that is when you're not going to enter for a sell. Then the price will do like this. It will go all the way down, it will turn down. So if it is for buy, all right, if it is for buy, then you are going to see something like this. The price will maybe consolidate or move in one direction or whatever it is. Then it will now spike down. After going down, you buy, then it will now go up. All right, it will now go up. So how can you make an entry with this? There are some people that use sell stop in this case and buy stop in this case. So if you want to use sell stop in this case, after taking the high, after taking the high, then you wait. When it's coming back, you put your sell stop around the highs. All right, that particular high, you put your sell stop there. Then the price will just take your entry, then it will move down. So the same thing applies there. If you don't want to use sell stop, all right, if you have a measured move, you can actually get where they are going to stop. Or if you don't want to do that, you can just measure it maybe 20, 30 pips above the high. You understand? So when it's coming back, then you're going to make sure that it has taken it out over 20, 30 pips. You understand? Over 20, 30 pips. It depends on, like on GBP USD, it's realistic. All right, from 10, but on USD from 5 upward, to 15, 20 pips. So after taking it out, then you are now ready to make an entry. So when you do all these things, you are going to get a very, very good trade. Now let's just go to the chart and see what we are talking about. All right. Give me a sec. All right. So looking at what we have here now, you're going to notice that this is January, all right? So January 26th of this year, looking at FTMO, FOMC, not FTMO, FOMC. Now, you will notice that the price has been going sideways throughout the day. As I said, do not trade before that, all right? So this candle got created, all right, and it went down. Then this is the main news. So the main news, when it started its own candle here, look at what it did. It went to the wrong direction. After going to the wrong direction, you will now see that it now went to the right direction. So in this case, since it started here and it went to the wrong direction, all right? So when it's coming back, you can just put your sell stop around here, then the price will go. It's just scalping. It's not something you're going to hold. Then you will notice that the price just tank all the way down. So this will happen during January. And remember, it took out liquidity. You have to wait for it to take out liquidity. Though it's not all of them that took out liquidity, but most actually took out liquidity. All right. So when it takes out liquidity, it means it's not going back there again. It means it's not going back there. If it doesn't, there might still be, one or two reasons why, it might actually go back there. So this is January. Then if you look at February, sorry, this is a very, very good trade. So if you look at it, you will notice that during that particular time, the price went down, taking out the money session low. That's the London session low. Took it out. After taking it out, look what happened. The price retraces and it went, just kept going on to the north. All right. So this is another very, very good example. So imagine you want to trade this. The price open here, then it spiked down. All right, so when it's going up, you have your buy stop here. Pick your buy, it picked your buy stop, then it started going. So this is a very, very good thing. All right, this is a very, very good thing. So the thing here is, let's say the candle opened around here, then it went up, then it now comes down, then it now went up. How are you going to do it? It is very simple. The answer is the candle did not take out any liquidity. All right, so in that case, I'm not going to trade it. So I'll prefer the one that took out liquidity. So the price open here, took out liquidity here. That means the right direction is up. You know, they've taken out a lot of people out. So they are going to use money as liquidity to actually move to the upside. You understand? So let's go to another month. So this is May. Look at May. The price went all the way down, took out liquidity, then boom, started going all the way up. So if you have your buy stop here, boom, you understand, you can make your profit here. You can make your profit here. So let's say the price goes up, touching this other block, then coming down. Are you going to trade it? The answer is no. Why? Because it did not take out any other block, any liquidity. So assuming the price just goes up first, taking out this liquidity, then we are going to sell. But since it was coming down first, then we are going to buy. So this happened in May, all right? Then this is June. Look at June. The price started here, went all the way down, took out liquidity, then from there it started going up. Even I've seen some traders that will actually put their buy stop after the liquidity. You understand? They're not going to wait for the open so that they can maximize their profits. All right. So look at another month here. We've treated like 3 months, right? So that is January, March, April, January, March, May. That is 3 months. Then this particular month, that is June, July 27. Look at what happened. The price went all the way down, but it did not take out this liquidity. It did not take out this liquidity. So in this case, what are we going to do? One, we might leave it and count it as a missed trade, which is the best thing. Which is the best thing, because you can't actually, be successful in all. It's not 10 over 10, but it's something that actually will give you more profits than loss. And that is what a trader is after, an edge, all right? And this is an edge. So the price went all the way down, did not take out any profit, then it's actually goes up more than 100 pips. All right, so this is also very, very, very nice. All right, this is very nice. So this happened around July. Then if you look at September, all right, if you look at September, you will notice that the price started here, went all the way down, then all the way up. All right, then after the close of the candle, boom, everybody is out. All right, some people might ask me, where can we take profit? You can take profit at the close of the candle. You understand? Sometimes it will move more than that, but sometimes it won't. Look at this, end of the candle, that is 1 hour. After 1 hour, you are gone. Then if you look at this, the price went all the way down. Actually, the price went all the way down. Okay, sorry, not here. The price went all the way down, then all the way up. So if you take your profit here, it's still okay. And if you don't, if you take your profit here, it's actually fine. But you can't guarantee that you are going to be waiting for 2 candles every time. So if you look at this is a very good example. Look at it. The price took out, the morning session high, then it started going all the way down. After taking out liquidity, let's say you now enter with a sell stop, all right, around this liquidity area, you're still going to make your money, a lot of money, all right, because it's always go to the wrong direction. Look at, I've shown you from January to November, this November, all right. So the one we're having tomorrow will be December data, which I don't have yet. But if you look at this scenario, this principle, you'll be able to trade it successfully. All right, you'll be able to trade it successfully. So guys, this is it. And it's very, very nice strategy. All right, very, very nice strategy. You have to be patient a lot. and you just have to allow it to move to the wrong direction first before coming to the right direction. So that will be all for now. If you have any question, you can have. So I assume there is no question. So let's leave it like this, and let's see how tomorrow plays along. All right. Make sure I'm going to send this video to you guys, so you watch it, you rewatch, and you practice it. All right. So thank you guys. We are going to talk later.
Buddy, now I got one question. Do you have some time to answer it?
Yeah, you can ask.
Yeah, the question is because now no one knows the direction of the price, and the like institutions and big boys, they are building their positions before the news. They are not
Yeah.
gonna be able like to throw like big lots now during the news time, so they are building their positions before the news. Are we gonna able to see them on a order flow profile on a Ninja Trader?
You're going to see them on the book map, not Ninja Trader. So if you have book, I use bookmap, because with bookmap you are going to see the LOB. All right, the limit order, we call them the LOB. So there are some that are hidden, which you are going to see it on the bookmap. All right, I think there is one video that I discussed that on the bookmap, is on my YouTube channel. You can check it. So
no, all right, I'll go through now, because it's like for the NFP as well. They are building their positions before. They are not building their positions like not during the news.
Yeah, not during the news. Institutions do enter with limit log, with limit orders. You understand?
This
That
is
is
like
why
the book map, you call it, is like point of control, right?
it's more efficient than point of control, because Ninja Trader has point of control.
No, all right, I see now. Thank you very much, brother.
Yeah. So on Ninja Trader, it also has the one that we normally use for limit order, but is not as efficient as the book map. You understand? So you can only see 10 price above, 10 price below using the Ninja Trader. All right. But with the book map, you are going to see, even if you have a order after pips, you are going to see it on the book map.
All right, I got you. Thank you very much.
All right. Yeah, you're welcome. All right. So guys, that'll be all for now. We'll talk later. Bye.